found that I went through another renaissance this year, and I wish I had gone through this second renaissance many, many years ago. But still, I think like Charlie Munger says, we are old too soon and wise too late. And but better late than never. So I want to talk about one aspect of the Renaissance that I went through, and it's changing my approach to investing quite significantly. A lot of these things will appear very obvious to you. Some of us, like me, are not that smart, so it maybe is not so obvious. But let me share these with you, and then we can talk about it. So so if you're an investor, a value investor, really at the highest level, you've got kind of two kinds of options in terms of the businesses you can invest in. You can invest in what I would call growing pies, these are businesses which have strong growth ahead of them. They've got long runways, and these businesses can get pretty large, and one can do quite well investing in growing pies, even if one is paying what might appear to be an optically expensive price. And there are many advantages to being an investor in growing pies. You can set it and forget it. And this is really one of the only ways you can really get to really strong multi-bagger returns, maybe 10 times your money or 100 times your money. So growing pies is definitely a great way to go. The second way to invest is discounted pies. And discounted pies are 50-cent dollar bills or 40-cent dollar bills. And here you are on a treadmill of activity because you have to buy and sell, then again buy and again sell, and keep doing that. In taxable accounts, it can be tax inefficient. And it's difficult to get more than a double or triple, because if you bought a company at 50% off and it did not grow and you were correct about it, then maybe you will double your money when that valuation gap closes. And maybe even if it gets some growth, you might get 3 times your money or something, but it's hard to get more than that. When I started as an investor in 94, having just heard about Buffett and so on, I was focused on growing pies. And the period from 94 to about 2000, 99, 2000, was a period of very strong stock market returns in the US. It eventually kind of peaked with a very massive bubble, the dot-com bubble of 2000. And then, of course, the NASDAQ index crashed and burned. It dropped about 80%. And even the S&P had a very long period of no returns. And I could see by 98, 99 that things were getting frothy, and I had done really well in that period. In fact, captured 200 baggers in that period. I was a individual investor at the time. I was not running a fund, but then I got concerned around late 99, mid 99, that this party at some point will end, and it'll probably end badly. So the market was really interesting at that time because there were a set of companies that were very overvalued, but there was another whole set of businesses which were not sexy businesses, which were very modestly priced and even maybe severely underpriced. And so one could actually make investments in those businesses. So for example, in 2000, the day the NASDAQ peaked, I think March 6th or March 9th, 2000, was the same day that Berkshire Hathaway hit a multi-year low in stock price. I think the Berkshire stock price at that time got down to about 40,000. And it was literally that people were pulling money out of Berkshire Hathaway and putting it into pets.com or chemdex.com, all these different kind of euphoric e-toys and all these things that were going on at the time. So I switched in the early 2000s from investing in growing pies to focusing on discounted pies, because I thought the index would give me a lot of headwind and what were traditionally growing pies were were quite overheated and such. And what I should have done probably maybe a few years back, maybe 3 or 4 years ago, 5 years ago, was I should have switched back because we did extremely well with discounted pies in the funds because the index, the Nasdaq was flat from 2000 to 2016. It basically went nowhere. In fact, it went down quite a bit before it got back to the same 2000 level. And the S&P 500 was flat till about 2012. So they took a long time to get back to their previous highs. So obviously, the better way to invest between these two is growing pies, but you also need to keep in mind a little bit about where the market and the index is at, where you're not kind of getting to euphoric, if you will.